Well, good morning for some, good afternoon for others, depending on where you're calling in from. My name's David Walsh, President of Canopy Strategic Partners, and glad you could all join us here today on what I think is a very important and timely topic for all of us. I'm sure the economy is on many of your minds, both personally and professionally. So what we hope to do here is just kind of talk through it. I wish we had the magic crystal ball of we could figure out kind of what exactly the next day, month, year will look like, but really just talking about kind of what we are all seeing from our respective industry perspectives. And we're joined by three expert panelists to talk about what they're seeing from an economic side, a consumer trends, and a philanthropic side within the market, and really focusing on cultural attractions, nonprofits here. I'm joined by two of my colleagues on our economics team, Zachary Winfield and Harriet Resnick. They'll also help join in with some questions. We are recording this conversation so that we can share it out, and we will share it out to all of you along with some follow-up notes and summary of the conversation. And we also encourage you to participate in the conversation. We'll start off with a couple of questions, but then we'd like to turn it over to you and ask some questions, and also encourage you to put any questions in the chat, which we'll be moderating throughout. So with that, I'd like to have our three panelists introduce themselves. Mike, I'll turn it over to you first, and welcome.
Great. Thank you, David. Thank you very much for having me on. Delighted to be here. My name is Mike O'Neill. I'm the founder and president of Beneficence Partners. We are a fundraising consulting firm that specializes in campaign feasibility, organizational alignment, gift strategy, working with boards and presidents, et cetera. And we also do executive search in the philanthropic arena. Prior to founding the company in 2022, I was the senior vice president of advancement at Villanova University for 14 years, and I've also spent part of my career in international philanthropy, as well as at other nonprofits and universities like Fordham University, Marist College, and St. Peter's. Nice to be here. Thanks so much.
Great. Thanks, Mike. Jerry.
Good afternoon. I too like to thank you for having me today. My name is Jerry Henry. I am the CEO of H2R Market Research. We are a management consultancy that specializes in custom consumer market research in the travel, tourism, and attractions industry. I've been doing this for about 40 years. Half of it has been at attractions themselves, and then the other half since 2004 as a supplier. With that, I tend to be the quantitative guy on our team. And H2R, I should probably say, is naturally, because we're a market research firm, we're naturally grounded in data that is fueled by disciplined market methodology, as you'd expect. But we also pride ourselves in having a deep understanding of human behavior and a passion for guiding our clients to help make smarter, more meaningful connections with their guests.
Great. Thank you, Jerry. And Aran.
Yep. Hello, everyone. Hi, my name's Aran Ryan. I'm with Tourism Economics, which is a practice within Oxford Economics. So our tourism team focuses on forecasts of tourism behavior, also quantifying the economic impacts of tourism, and then sort of the overlay of tourism on other local economies and attractions, other facilities. So looking at live events, attractions, hotels, hospitality, various assets. And then our connection to Oxford Economics brings us a view of the current economic environment. So happy to share some observations on that as well.
Great. Thank you, Aran. Well, I'll get started, Jerry, with the question for you. Kind of given all of what's going on, and given these current economic conditions and what we're hearing and seeing in the marketplace, what trends are you observing in consumer behavior, and how do you think that could impact any sort of visitation patterns to cultural attractions?
A little bit of a tale of two cities, because the trends that we had been tracking as we entered 2025, where we were seeing a lot more visits coming from people away from home or travelers, people that had traveled more than 50 miles. Matter of fact, that ratio set a record among the attractions industry last year. We were also seeing more families visit. Interestingly, they were visiting with a little older child last year. Teens represented 10% of attendance, whereas our norm is 7.7%. And so that drove the average age of the child up to 9.5, which is the highest that we'd seen in a decade, as well. Some good things. Net promoter scores, satisfaction was really high across the attractions industry last year. In several cases, we were seeing records for net promoter scores and different levels of satisfaction. My favorite, however, was economic outlook, and that as we closed 2024, we got the highest ratio of people saying they expected the economy to improve that we had ever seen. Isn't that good news? Unfortunately, as we have found ourselves over the last couple of months, I would say that uncertainty has now become the new normal, and we're in the process of unraveling many of the trends that we recorded from 24, or I'm 25 still early. So what we're seeing is the consumers naturally cautious because of economic instability over the last 5 weeks. That economic anxiety is real. I'm sure Aran's going to tell us a lot more about the financial metrics of that, but I can tell you that according to the University of Michigan, consumer sentiment is sitting at the second lowest it's been in 70 years. Consumer confidence from the Conference Board has dropped 4 months in a row, and closer to home, visitation among cultural attractions is down 7% year to date through last week. So that's a bit of a concern. The good news, though, is in a study that was just recently conducted, travelers looking at the rest of the year are telling us that they're trading down, but they're not trading out. That is, they're still planning to go. So that will be good news. And then for many in the cultural attractions industry, if this year gets closer to a recession, not saying that would happen, but if we get closer, we're probably going to start seeing people stay a little bit closer to home. That's already occurring in the past 5 weeks, limited sample size, but we're seeing more visitation from locals and less from travelers. And then just a couple evolving behaviors that could create some market fragmentation going to this year is more digital social connectedness. That is, people socializing at home and feeling they don't need to leave home. And as it turns out, people are now spending more time at home than they've ever spent, that's ever been recorded. It's difficult to leave. So to get them out of their homes, the attractions, the exhibits, the rotated programming that we put out there really has to be epic to lure them away. One way is psychographically because they want to get away from screens because they're sick to death of computers and televisions and Zoom. And the other one is social seekers, actually while I can socialize at home, getting away and being able to eat, drink, and socialize and reconnect with friends together are important trends that we think will continue well into 25.
Great. Thanks, Jerry. Aran, I know you can add to that perspective. Kind of what are you seeing in terms of those tourism trends as you look at the market?
Yeah, so certainly a fascinating time to be an economist, maybe a little bit less fascinating to be on the operating side of things. It was interesting to hear Jerry's recap. I guess on the tourism side, domestically, we're not yet seeing a pullback. So right, there's certainly a lot of headlines and a lot of uncertainty, but it's not yet showing up in the data. As economists, right, we're trying to look ahead. So we see an environment where it's a decelerating economy. We think consumers are going to be pinched by tariffs, that there's going to be less business investment, that there's going to be higher unemployment, there's going to be higher prices, and we're going to see weaker consumer spending. We're not there quite yet. The other spot is we're not quite at a point saying that the most likely outcome is going to be a recession. It may be, as we see more data over the next 4 weeks or so, that call shifts. But at the moment, our April baseline expects this decelerating, but not necessarily a recession.
Well, that's good news. Glad to hear that. And Mike, I know all of what's going on from an economic perspective and in the market surely has to have some impact on the philanthropic world. And kind of what are you seeing in terms of some of the both current and maybe upcoming challenges from a philanthropic side?
Sure. Thanks, David. And looks like there was some breaking news there. We heard it here first, Aran. There's no recession coming, so we'll write that in stone. So that's great news. So yeah, actually, in preparation for this webinar, I reached out to a dozen or so VPs of advancement, as well as about a dozen or so ultra high net worth or high net worth individuals, and no one has really on the institutional side, no one has really seen a fallback in terms of their year-to-date numbers. Most of the institutions that I've spoke to are having robust years, but they are clearly concerned. Some have enacted hiring freezes, which I always think is a mistake on the fundraising side because it's revenue generation. There are other ways in organizations to save dollars. LaSalle University, for instance, last year, their Day of Giving, which tends to attract not major gifts, but smaller incremental gifts, did $500,000. They raised 1.9 million in a single day versus 1.4 million last year. So that kind of is counterintuitive to the headlines. But when you're speaking with folks who have family offices or family foundations, and their family foundation goes from 100 million in January down to 80 million, in the span of a handful of weeks or months, it does cause folks to take pause, perhaps get through this grant round and then take a wait and see approach. I think you'll see donors of all stripes and varieties, as they're pausing, kind of reorder and look at their priorities of giving. So maybe their top 5 philanthropies now gets whittled down to their top 3 until this fleshes itself out. So what's really, really important for any nonprofit organization is to double down on stewardship, to really connect and stay connected more than ever with their donors. You can never say thank you enough, and you can never connect with your donors enough. So there's no alarm bells going off at the moment. And certainly we've gone through, and I'm sure we'll talk about it later, gone through some different unprecedented times with COVID and the 08-09 financial crisis. And philanthropy always seems to withstand these very, very challenging tests.
Mike, just building on that, kind of, I know the government is kind of pulling back a lot on funding a lot in the social services sector. Do you see some of the existing philanthropic dollars being shifted to some of those needs that may not be met now out of the government sector?
Yes, absolutely. And I had some concrete examples about that in some of my conversations. In some ways, it's a little ironic that philanthropy now, given all these cuts, is more important than ever. And so whether we are related to social services or we're an attraction, I think it's important for all organizations to really talk about their compelling human benefit elements. So if you're a zoo, it's about conservation and research and extinction and things of that nature that really serve the common good versus a day trip, for a family. But yes, I've talked to donors who perhaps were giving to their university or a pet project, and they've shifted their focuses to food insecurity or double down because these tariffs might be argued that they're also regressive, and who are they going to affect the most? And that's folks who have the most need. And so typically, during times like this, arts organizations suffer first. And because it's not automatically people don't automatically have their perception related to the human services part of it. But I still think you can make a strong argument that art has a compelling social and human service connection to it. So I think if this lasts for a very long time, I think we will see the same type of changes that happened in the post-COVID world.
Yep. Okay. Thank you.
I'd love to hop in with one. A lot of the folks, I think, in the industries that Canopy serves found that in previous recessions, especially, the most recent one, their organizations fared generally quite well for, a whole multitude of reasons. And I know we're not officially in a recession, but it is starting to feel a little recession-ish or pre-recessionary. I'd love to hear from you gentlemen through the lens of your kind of respective expertise. What are your expectations about how similar or different this environment is from the previous two, right? 08, 09 and COVID, in terms of just like the big picture macroeconomic conditions. Basically, like, is there something markedly different about today's environment than those previous two timeframes?
I'll jump in. I don't want to dominate here by any means, but there are certainly some similarities, but in many ways, it's not really comparable at all. 87, 2008, 09, were severe recessional and almost Great Depressional market fluctuations that were connected back in 08, 09 to the subprime mortgage situation and so on. This, not to take a political tone by any stretch, but this seems to be much more self-inflicted, and it is happening in real time, and it's fluctuating on a nearly daily basis. So it's hard for folks to understand where it's headed. Where, in a typical recession, there are economic precedents that you can look back and say, well, it should typically last, going from bear back to bull over a certain amount of time. So in that regard, you look at, very little M&A happening, IPOs. There's really not a lot of, anybody buying anything at the moment. So that ultimately affects a philanthropist's pocketbook. I think where the reaction is going to be, like with COVID, something truly unprecedented. I think that's where the biggest connection can be made with the COVID, because it was certainly unprecedented on a global scale. I think, organizations that are invested in community programs, can restructure for leaner operations. They can recover more quickly. I think, and I think, Jerry, you had mentioned this earlier, where folks are kind of accustomed to taking like I had a call with college friends, reunions coming up, and, we had it felt like a COVID cocktail hour. We Zoomed to talk about making our plans. There's that type of thing happening again. So this is a really great opportunity for cultural organizations and attractions to really, they know what they've learned and what they specialize in and became expert at, in reaching out to their donors in a very select, segmented way. That value add that you can do programming, high-end programming within folks' homes, and that's a stewardship and a cultivation opportunity as well. I know the Barnes Museum, for example, in Philadelphia, was really expert at that. I happen to be a member there, and it was really relishing during COVID. It gave us something to do where you felt like you were enriching yourself.
If I could follow up with a question, Jerry, you mentioned that people are still going on vacation, but maybe more like staycationing or maybe drive distancing. As people think about pricing, because a first place that a lot of organizations might think to go to raise income is their admission fee, which is usually their biggest nut. What do you feel that the temperature is out there in terms of price sensitivity in the market? Should organizations think about creeping up, $1 or $2? No one's going to notice, or are people still going to be feeling very price sensitive?
Weirdest 5 years I've ever seen. We've used predictive pricing measures with discrete choice conjoint for a very long time, and I would say price sensitivity is increasing, but has been since 23. This is not anything new, and it's happening across all demographics. I don't care what income level you are. What is unique is what occurred immediately after COVID, when people were cooped up for 12 to 18 months and the desire to get out and to do new, fresh, unique bucket list kind of things. And that still exists today, but there for a while, man, you could charge virtually anything you wanted. And if you had a quality guest experience, boy, they were going to pay it. Consumers were spending like drunken sailors. And per caps soared across the attractions industry and still remain high. Beginning about the middle of 2023, I can tell you the price sensitivity began to increase true across demos. And so I think it is going to continue to be there because of it's just been so jolting. As Mike pointed up, it's up and down and it's by day and people just don't know what to do. Uncertainty is the new normal, but it's not uncertainty of an era or of a year. It could be uncertainty of a week. And human beings really crave certainty. Our brains are wired to look for what comes next. And the reality is we don't know right now. I think that is in the short term going to make people even more sensitive to price. That's the bad news. The good news is the value proposition has dramatically changed in the last 5 years, and that COVID did change everything. It wanted us to find fresh, new, different. The per caps were up. Premiumization of experiences has been a trend for the past 5 years. Those fresh, unique experiences is what people wanted. And the average income of attractions visitors nationwide and travelers has been going up quite a bit. So the definition of value changed in all of that. It used to always be price and quality. Now I would argue that the definition of value is price, quality, and uniqueness. Is it different? So the point being is if you can differentiate yourself by a fresh, new, quality guest experience that is slightly different, then you probably do still have some pricing power, despite the fact that there is growing price sensitivity in general.
Aran, maybe you can pick up on Zach's original question if you feel this is different or how is this different, but also I would also like to hear if you're kind of seeing any differences from a regional perspective. Are different parts of the country, or is this kind of everybody's impacted by this?
Yeah, I mean, I think what's different about the current environment for me is sort of the threat to funding, sort of the direct threat to funding for so many organizations, which is like a direct contrast maybe to the COVID situation where more funding and support was available. So those contrasts are very real. I think that in terms of the regions, we do expect the tariff type impacts to hit sort of legacy manufacturing areas a little bit harder. So your Detroits, Cleveland's, Chicago's type areas. I'm also sort of cognizant of the division we've seen before between lower and medium income households and higher income households, and just all the pressures that we've had on those lower income areas are going to become, sort of redoubled here with the tariffs and a weaker job market. So if I think about price sensitivity and I think about what the customer base is, that's something I would be very conscious of.
Okay. Building on that too, kind of if you look at which audience segments, market segments might be a bit more resilient during this time for each of you, I think from a philanthropic side, a spending side, a travel side, kind of any perspectives each of you wanted to share.
The easy one is affluent older adults, because affluent older adults have had a lifetime to buy stocks, bonds, and put money away. And they frequently drive the multi-generational travel trend that has been out there for a while. They may not drive it, but they certainly fund it. They're the banker of that. And so, again, I'm not saying they're not price sensitive, but they're also the ones helping to drive the premiumization trend. So that's one segment that I don't think I think they'll be a little bit more resilient. Another segment is families with young children. You only have a really brief moment in time that you can create memories with young children. And so recession, no recession, high prices, low prices, you know what? It's fleeting. And families with young children, I think, are still going to get their kids out and seek to engage them in fun and educational. I think that segment could truly help the cultural attractions. And they're also more likely to stay closer to home, but they are going to go out and keep spending. And the last one I would say is Gen Z and younger millennials are very values driven. And so brands and experiences that align with their values, they will tend to support far longer than those that are maybe just they perceive as being profit driven or more commercial. So those are certainly three segments that that I would call out.
Well, those are all good segments for a lot of our markets. Zoos, gardens, cultural attractions. So that's
Yes.
great to hear.
Yes. And by the way, I kind of agree with Zach. If we do go into recession, well, I agree with Mike too. The world's totally different. Two things can occur at the same time, and that is the premiumization trend can continue, and people may also be trying to stay a little bit closer to home so they don't spend. But it could largely be different people doing that. I think it is possible that cultural attractions, I'm not going to say recession, but if it slows down, could actually benefit from looking for unique things just closer to home.
Mike, how about from a philanthropic side, which of those demographics or segments most
Well,
resilient?
I really agree a lot with in those exact segments that Jerry was talking about. I think particularly the older affluents, who have stock portfolios that are long held and still have significant value over time. I think this, which allows organizations to have different sets of conversations related to plan giving, which is the most effective cost per dollar raised still to raise money. I think Gen Z and younger are incredibly values driven. And as you see cuts in social services, DEI programming, and then, health research, I think those are organizations that are getting increased interest from the younger generation. And also, too, particularly those who are in donors who are in urban areas where lots of cultural organizations tend to sort of comprise themselves. I think, they're still going to need to nourish their need for that, but perhaps they will curtail going to a destination, and they'll take a harder look in their own backyard. And so there's opportunity for everyone in this environment, but it's just going to be a little bit more specialized and segmented.
I was reflecting a little bit on what you said, Mike. I forget some of the terms you use, but the expectation that people would focus some of their giving on their core. I forget the term, but sort of narrow a little bit, and I think that fits into the also this context that we've put a lot of culturally topics on the table, whether it's DEI or just a whole slew of things that the discussion is getting reset in dangerous sort of complicated ways, and it does get directly, I mean, for a lot of people, directly at the stuff they want to support most directly. So it's I think there's sort of a powerful recast of some of those relationships.
Jerry, we've worked on, dozens of price research projects together over the years. And you've always told me, the middle of summer, Christmas, terrible times to do pricing research, right? People's heads are just elsewhere. Is that true also for periods of kind of intense volatility or uncertainty? Are you having to view research results through a different lens right now because of the headspace that people are in? Or are you finding that that's not a factor?
That is a great question. At the end of the day, human beings are emotional. We tend to make decisions far more on how we feel than the logic. We think we're logical, but most decisions at the end of the day are driven more by emotion. So to answer that question, what I'm encouraging, we now have several studies starting, is whether it's in their longitudinal research that they're measuring guest satisfaction, or we're setting up some weekly or monthly leading indicators within their own properties. I how you feel the moment you take the survey matters a lot. And so whether you're asking about economic outlook or job security, or whether you're going to take a vacation, yeah, is that impacted what you just heard on CNN or Fox News? You bet it is. And so my recommendation is an ongoing pulse measurement, because you are going to get this. But I got to tell you, right now, we're kind of in a moment of unprecedented uncertainty in terms of the compression of which that instability has happened. My 401k went to a 201k, went back to 301k. Now it's nearer to a 401k. The fact is, we don't know what to expect. And just anecdotally, I can tell you emotionally, my opinions have gone just like that. I very much expect respondents to vary that same way. So you have to ask ongoing questions that you expect to measure over time, and then values-oriented questions tend to remain pretty stable.
We had a question in the chat here of, does anyone have any data on what the top ranked values are for Gen Z?
I do, but not off the top of my head.
Yeah, I don't want to misspeak.
It's deep in data somewhere. Although, you know what, my take would be exactly what we have talked about in that. So what are their values? And I think it is DEI, inclusivity, earth-related things, climate change, they seem to be better at thinking long term than perhaps their older counterparts. But off the top of my head, I couldn't tell you quantitatively what those are, but my guess is they all range in that. Keep in mind that Gen Z is the most diverse generational cohort that exists, that has ever existed. Well, that's not true, because the younger than Gen Z now are even more diverse than they are, but it continues, and so naturally that reflects in their value system.
Yeah, what I have seen, and this is purely anecdotal, is very much the experiential economy. That Gen Z prizes the experience, and they are also not going to delay. They don't like the delayed gratification. That they're going to kind of do it now because they don't know. I think this uncertainty for them is scary. But it's like it makes them want to do things now and take advantage of these experiences now. That is purely anecdotal, but
David,
I've seen it in action. So
I think you're right. I think also Gen Z, unlike perhaps past generations when they looked at philanthropy, they looked at it as something down the road when they have the ability to make a gift of impact. Gen Z and younger look at themselves very much as investor philanthropists. And so, whether that translates into a gift of $50 or a gift of $500 or $5,000, they want to understand where that money is going. They want to earmark it, so unrestricted giving drops, because they want to be a part, they want to be deeply engaged in the organizations that they choose to support. And so organizations that listen and segment and really segment messaging to their audience are the ones who are going to thrive, particularly in uncertain markets.
I have a question for Aran. Oh, sorry, David.
no, go ahead.
Okay.
Might be the same one.
Everybody's trying to plan, but it's hard to plan in a time of uncertainty, especially as a nonprofit, right? You always want to make sure we can pay our bills. So looking ahead, what are some economic indicators that people on this call should be looking for as early warning signs that behavior will start to shift? Because if you're going to sort of forecast that attendance is going to drop, 10%, you're going to need to plan for that. Like Mike said earlier, he's seen organizations doing holding on hiring or even doing layoffs. So are there some things that we should all be watching for as sort of red flags out there?
Yeah, it is a difficult spot. I think that one of the airlines recently on their earnings call said, yeah, we have two scenarios. We don't know which one's going to happen, right? Here's our baseline. Here's what we think our performance is going to be. And then, here's the recession scenario. And, we'll pull that one out when we're tipping that way. So I think that approach is good, right? Two ways to think about things. Just some of the traditional economic indicators, whether it's sentiment or job market, I think are going to be key. Consumer spending. I think there's wealth effects, so that if the stock market continues to drop, yeah, that does feed through to people. I don't know the direct impact on giving, but when we see it in other parts of the economy, it does feed through to what their consumer spending and so on. So I'd pay attention to those. If it's attractions related, I guess I would pay attention to what's going on in travel and tourism. One area we are watching pretty closely is the international inbound situation, where all of the trade policies and the rhetoric and the sort of unilateral positioning has really shocked a lot of our friends to the north and in Europe and in other areas. And so we have been talking to clients for a couple of months now about the expected impacts, and now we're starting to see them in the data, with many fewer Canadians coming, fewer Western European visitors coming. And so the amount of international visitor spending that we expect in the US is about 20% lower than our expectations going into the year. We thought this was going to be a pretty good year of growth, and we're still rebuilding that market. And now it looks like it's a market that's going to be retreating. So I think those areas that particularly impacted those major gateway cities, but also markets that are dependent on Canadian visitors. Just for example, the March data on land visitation from Canada was down about 30% year over year. And that was happening surprisingly quick. I know that they're pretty irate with the situation and still being polite about the cancellations, I understand. But yeah, it's like that's a big shift to the business in a lot of these markets. So certainly that's an area to watch as well.
I also think it's important, while we're looking at these trends, that and it's so hard to anticipate because of all the daily and weekly changes that Jerry was referring to, but looking at all organizations that want to not just survive this but come out better on the other end. This is an opportunity for scenario planning, best case, moderate, and worst case scenarios, from a budget forecasting standpoint. I would really encourage organizations to preserve their core capacity. While they may have to make cuts or hiring freezes or salary freezes, I think it's essential to, for example, I was at Villanova. I joined in 2008 of June, and that fall, the D word started being bandied about, the Great Depression, and I wonder what the heck have I got myself into. And Villanova at the time had a hiring freeze and a salary freeze, but the hiring freeze excluded essential student services related to security and health and wellness and advancement, which I was happy to hear, because we're a revenue generating source. We're the mission. Regardless of what type of nonprofit you are, you're a mission-driven sales team. And so, having the appropriate boots on the ground to stay connected to the donors, to share the compelling mission, particularly in uncertain environments, is really, really key. And why would you ever cut a revenue source? And in often cases, it's your primary, if only, revenue source. So and then there's also an opportunity, even if things are slowing down with donor dollars coming in the door, there's an opportunity to internally invest in resilience. So using this period of uncertainty to invest in systems, reviewing your CRM systems, your financial reporting, staff training. Perhaps it's an opportunity you've been waiting to do a database update or a rating and screening of your database, a records refresh of addresses, all those types of things. That while we're out there, being external and trying to raise money, that we often leave to the wayside and will ultimately hurt us in the long run anyway. So that there's different things that we can do to shield us during this time and make us better when things finally settle down.
Mike, you mentioned the Villanova experience, but when we talked before, you had also brought up Boston College and kind of the capital campaign. And I think it's just very interesting in terms of timing as people think about campaigns. Would you share that story?
Yeah, sure. This was right around 08, 09. I don't remember the exact specifics, but it was right when I had arrived at Villanova, and we were girding the machine for a campaign and wondering what the number should be. Should we delay it? Should we not delay it, et cetera? And I remember reading an article that stuck with me to this day in the Boston Globe. It was at the height of the crisis, and there was an interview with the then president of BC, Father Bill Leahy, and I think they had announced $1.25 billion campaign. And the question from the reporter was, how in this market, why do you have the wherewithal to do this? Are you being brash? Do you have your head in the sand? What do you think? And his response was so simple. It certainly was bold, but to me, it was compelling. His simple response was, in a world that is ever changing, now more than ever, the world needs Boston College. And we can all take a page out of that playbook, right? I've tried to do that with St. John's University, for example. They are kicking off a $400 million campaign on May 1st. 6 weeks ago, the working goal was $350 million. That institution used very closely to its founding mission of educating first generation college attendees. Something like 50% of their students are Pell eligible. So keeping the doors open and providing financial aid is a really pleasant and necessary obligation. And as I've heard more than once before, mission costs money. And so they elevated, in these uncertain times, they elevated their working goal, their launch goal, by $50 million. And so to me, the future favors the bold, provided that the blocking and tackling pieces, there's a really good time to look at the blocking and tackling as well.
Thanks, Mike.
We've got a question in the chat from Sarah Wood. Is there any data on which areas, I think she's talking about operating areas, seem to be taking the most significant hits at attractions? Are consumers spending less on food and beverage, gift shops, rides, etc.? Or maybe expectations about which areas might be impacted?
I haven't seen data on that yet, but it's still very early in the year. I have, thanks to geolocation intelligence, seen the types of attractions that are doing better than others, but I think that's a different question. My guess is, and my guess, and 50 cents will buy you a can of Coke at Walmart, but my guess it'll be merchandise and gift shops that take the biggest hit, because if they choose to visit, all they have to do is find the best way to find the appropriate admission into the attraction. And then likewise, if they stay long enough that they get thirsty, they're going to buy a beverage. And if they stay long enough, they're going to buy food. But what they don't have to buy necessarily would be merchandise. And if we also have a trend of people do start staying closer to home, they've been there before, so they feel less necessary to buy a souvenir. So that's a guess.
I also wanted to ask a follow-up, Mike, pursuant to your comment about fortune favoring the bold and your experience at Villanova and the sort of the protection of the revenue generating areas. I think that when money is tight, it's the instinct of a lot of organizations to cut back on what they view as non-revenue generating areas, which tend to be sort of the more mission forward kind of operations. But is that short-sighted? Like, do donors notice that kind of thing? And will that cost an organization in the long run?
So first, I like to get the address for Jerry's Walmart, where you can get a can of soda for 50 cents. My can of Diet Pepsi cost me $2.79 today. And that's how I track my own inflation by my Pepsi addiction. Yeah, I think it depends, Zach. If the cuts they are making are wholesale, if they are avoiding long-term priorities like new education programs or market-ready education programs or something on the cultural side of things that is of the latest and best and of the future, donors will certainly notice that, and trying to switch or to pivot so quickly for other short-term gains, which aren't so thoughtfully thought out, I think donors will notice that. So that is why I certainly behoove my clients and always try to put into practice, looking at how you strengthen your donor stewardship, doubling down on gratitude, personalized communication, and impact reporting, because ultimately it's about impact. What is the impact that the organization is doing? And if you're cutting your key or core areas, that impact is going to be diminished. And that's something you can't hide from. I think you need to segment appeals by interest and capacity. I think you need to leverage data for smarter outreach. And really reframe the value, communicate how cultural engagement and cultural organizations support well-being, equity, and education. It's not just an entertainment or a destination. And then I think it's important to explore alternative giving, whether that's cryptocurrency, donor advised funds and things of that nature. Donor advised funds is something that just keeps on growing, and a lot of organizations are creating their own white glove DAFs. But yeah, I think the more you vacillate from your core, the more exposed you are, and the more you risk diluting your brand and diluting your mission under any circumstances.
Aran, you had talked about some of the economic indicators, and through Oxford Economics, you may have kind of a broader insight into the economics. And I think about our clients, and there is definitely some short-term pain here, but I think we have to also look at the long term, because zoos, aquariums, gardens, cultural attractions have stood the test of time. Most have been around for a really long time. Kind of, if you look at the economy, kind of how long might this pain last, I guess? What do we have to get through so that we can kind of get to the other side, in your opinion?
Yeah, no, that's a good point, that when we talk about going through a recession or something, it would tend to be a shorter event. They get through in a year, start to see things turning the corner, that all of this upfront uncertainty about spending and investment is here, because there is so much we're uncertain about. But as people pause things, and then if we go through a period and it turns the corner, then some of those pauses go away, and people reinvest. And so, yeah, I think those types of organizations are in a good spot as everything starts to come back, and we're not seeing some long-term shift away from it.
Jerry, are you seeing any kind of things that are happening now that you could see as being more long-term trends here?
It's hard to say if they're long-term trends at this point, but I will say this: fear of what's to come can be completely disassociated with the actual financial metrics of what's happening in the markets, what's happening with prices, what's happening. It's how people feel and are worried about what's to come that is driving whether they're making vacation plans or leisure weekend getaway plans right now. Where I totally agree is, as soon as we turn a corner, that is, as soon as we get some sort of resolution to know what's going to happen with tariffs, what's going to happen with the tax bill, what's going to happen with interest rates, good, bad, or indifferent, once there is a little bit more certainty in the marketplace, consumers have a plan for that. If the market's down, they know what to do. If the market's up and things are good, they know what to do. I think the worst thing is where we are right now, and that's the uncertainty, where we're sitting on our hands, afraid to make any big decisions because we don't know which direction we think it's going to go this year. And so, that is a pause. That's not going to last more than maybe another month or so. It's going to become clearer soon. And once that does, I agree. I think this is probably most likely to impact summer travel, the most, possibly into the fall. But once there's clarity, I think things certainly clear up within a year.
David, I might add too, from an organizational perspective, one thing that I think will last longer than this current market uncertainty is, let's say that gets addressed and things settle down. The larger issue for any nonprofit, not just the higher education sector, is the potential taxing of endowments. And that's something that, philanthropy as a whole, seriously needs to come to terms with. My sense that it's more likelihood than not, and that would be a huge departure for American philanthropy as a whole.
Yeah. Okay. Well, we have about 5 minutes left here, and I'd like to close by asking each of you for your advice to the leaders of the cultural attractions that we have on the call here, there are one or two things that you would advise them to be doing here to get through these unprecedented uncertainty times. What advice would you offer? Anybody want to start? Aran?
Yeah, I was still reflecting on what Mike said about the threat to taxing endowments, and just kind of realizing, like, there's right. I mean, there's stuff on the table that's not on the typical playbook. And gosh, if I think about the funding sources for organizations, and what could happen in certain areas, that's got to be front and center. So I'd pay particular attention to those areas. And yeah, operationally, yeah, I think yes, we're going through a period of slowing, but we learned that a lot of these activities are pretty resilient, coming out of the pandemic and returning to behaviors. So we would expect that there too.
Thanks, Aran. Jerry, your advice?
Number one, this is old school. To get out in the attraction and talk to customers and listen to what they have to say. If nothing else, watch their behavior and listen to the conversations, but I directly engage them, because a lot can be learned simply by having a cup of coffee with your customers. Number two, I would monitor economic indicators. I would friend Aran on LinkedIn, and I would be monitoring tourism economics, and I would be monitoring economic indicators and what's happening to the market, because it does, consumer sentiment, confidence at 30,000 feet does give you a feel for how the general consumer marketplace is feeling. The third is, if you haven't, you might consider getting into geographic location intelligence so that you can contextualize your performance. If you're a zoo and you're down 2.7% so far this spring, and your board is just, oh my God, we're down 2.7%, what are we going to do? If you knew that the industry was off 7%, all of a sudden it doesn't feel as bad. So context can be a lot. And if you're not doing it already, longitudinal surveys so that you're tracking not just guest sat, still important, but how guests are feeling, because I think more than ever, it's going to do this thing all year long. And the more you understand what your customers are fearing or feeling, the better able you are to predict.
Thanks, Jerry. And Mike will finish out with your advice.
Sure. I'd close by reminding all of us that we are in mission-driven sales, and this is a relationship management business. So whether it's your donors or whether it's people coming through the turnstiles, your customers coming through the turnstiles, now is not the time to shy away from your customers. Philanthropic customers, or those who are coming through the gate. People give to people. And the closer you can stay, we should be doing this on a daily basis, but certainly in times of uncertainty, the closer that you can stay to those who are compelled and act on that compilation to your mission, the better off you will be. And always have the mindset that your organizational mission and your vision to accomplishing that mission is worthy of financial investment. It's how you make the case. It's always about how you make the case. It's about impact.
Great advice, Mike, and thanks for that closing comment. Well, I really appreciate all of your time and perspectives and insights, Mike, Jerry, and Aran. I have to say, I'm leaving the conversation a bit more optimistic here. I know there is some short-term pessimism, but kind of if you look at the long term, even some of the trends and how it could impact our client segments and the people on this call, I think there's some good news in here. But really kind of some good advice. And I think I'll close, Mike, with your comment. The future favors the bold. So let's be bold out there. Let's not shy away from the important mission work that we're all doing. But really appreciate it. We may be checking in with each of you kind of over the next couple months during these ups and downs. I guess it's buckle up, but we will get through it. So with that, I'll close. Again, Mike, Jerry, and Aran, thanks so much for the time, and appreciate all of you on the call that joined in. We will be sharing out a summary and the recording of this if you want to go back and listen to any of the key points that came out. So, and Zach and Harriet and Liza, thank you for joining in as well. Take care.
Thank you all.
Have
It's
a
a
great
privilege.
afternoon. Okay.
Take care now,
Bye.
everyone.
Yeah.
Thank you.